Hello and welcome back to Building Wealth on the Go, a podcast by KLT Wealth Management. Today is May 20th, 2025. We're back with season 6, episode 5 of our podcast. I'm your host, Brad Wilson, joined by my colleagues Joe Filimeni and Courtney Beach. Thank you for tuning back in. If you haven't already, make sure to like and subscribe on whatever platform you are listening to this podcast on. We do come out with these every month. And this month, we're diving into a topic of life insurance. It's a topic not a lot of people like to talk about insurance. It can be, one of those pain points for a lot of people. We have to pay it for a lot of things in life. When it comes to car, home, lots of different stuff. But we're going to dive into life insurance today, and not just what you might think traditional life insurance might be, but also some unconventional and some unique ways that you can utilize life insurance. So with that, we're going to dive right in today. And Courtney, why don't you kind of introduce and touch a little bit on the traditional ways life insurance is used, what it's used for. And those are stuff people might be familiar with, but let's do a little bit of a summary.
Yeah, so usually when somebody gets life insurance, it's to protect your loved ones if something should happen to you. So if you were to pass away, you want to make it so that they have time and the funds necessary in order to heal and to go on with their life as best they can, I guess. So you want to have enough life insurance to cover off your debts, they don't have to worry about those, and maybe to supplement some of your income so that if they need to take time off work, they maybe need to, take a vacation or something to, get back to somewhat normal, then that's what life insurance is for, is basically to help your loved ones get over that hurdle of you not being there, at least monetarily wise.
Yeah. And that's what's common sort of out there. You hear that all the time. There's commercials for it everywhere you go. It's quick and easy applications, get covered now. It's cheap, it's affordable. And that's the real main point. And that type of insurance is called term insurance. That really is there to protect you in the immediate term for your loved ones in any of those cases.
Yeah, and we should sort of note that, insurance in general, life insurance in general, is is cheaper yesterday because you were a day younger. So that's something to consider at the. I think you can distinguish life insurance based on sort of age categories. At the younger age, typically, you're more conventional in terms of the coverages. You've got your mortgages, you've got small children, things like that. Debts and obligations. You're insuring, your income for future as well. So at the early stage, it's really really cheap. In term insurance is inexpensive as long as you're healthy. That's the other
Hmm.
part of it too, because there is a health aspect, and that's very very important to understand the type of insurance that you're going to be buying, and so that you're well educated on what you have and what it's going to do for you. It's funny in this industry, when I first got into this industry, and I wasn't life insured licensed at the time, and just getting into it and trying to understand sort of the pros and cons of life insurance. And often with clients, one thing that they would say repeatedly to me is that they don't believe in life insurance. And I always question, I says, what's there to believe in? And I said, it's something to help you out when you would need it, or to help the people that you're leaving behind out. And it's no different than the insurance we pay on a house, insurance we pay on a car. And I think it's one of those necessary evils, especially in
Mm-hmm.
the early stages of growing up
Yeah.
and having a family.
Yeah, and it's funny when people say that is because the only thing you're guaranteed in life is you are going to die at some point. Medical science has not
Death
advanced
and
far enough yet.
taxes, the
Exactly.
only guarantees, right?
Yes. And so the idea, like you're saying, Joe, of term insurance is that when you're young, all these debts are, well, they're quite large. So you only really need like term insurance for a short period of time to cover up the large debts and stuff like that. And then, you know, which are going to dwindle over time.
Yeah. And that's where, like, I think Two, it's funny because you protect your house against worst case scenario. You protect your car against worst case scenario. Actually, through your car insurance, you protect other people through liability insurance, but you don't protect yourself, right? With life insurance. So it's kind of that irony of your health and your being and everything. That should be the one of the most important things to cover when you
Mm-hmm.
think of it at the end of the day. So I think it is one of those things that does get a bit of a bad rap, maybe life insurance, and I think maybe that's because of some of the complexities that we're going to dive into with life insurance and not maybe understanding or being, you know, having purchased a product in the past that wasn't what you thought it was, something like that. So those can kind of be the ways that people get skewed one way or another. But I think let's dive into what some of those unconventional ways are of using life insurance and the different products. And so I think the biggest kind of separator is we've got really two main buckets of life insurance. We have the term insurance that we talked about previously there, and then you've got what's called permanent life insurance. And often these are policies that you're paying into that are set in stone for your lifetime, or even now can be paid up in a shorter span of time, maybe 20 or 10 years. And they generally have a different purpose to them. So, Joe, why don't you kind of discuss a little bit about some of the purposes of permanent life insurance and how they can be really, really effective for clients?
Yeah, I think permanent life insurance has seen a resurgence in usage probably over the last 5 to 8 years. I've seen it in sort of my dealings with my clients. It used to be very, very popular whole life type insurance, permanent insurance back in the day, but that's changed a lot because everybody kind of switched to term because it was much cheaper. So term insurance is cheaper, but it is good for a term. So again, it's like the paying the insurance on the car. You're betting that you're never going to have to use it, so you want to pay as cheap as possible. Your whole life, it's going to pay out. Your permanent insurance, it's going to pay out. You know it's going to pay out because, as Courtney says, we're all gonna pass away at some point in time. So you want to kind of structure it in order to help with different things and the unconventional things. Sometimes if we talk about sort of the later stage of life, you're probably planning for more estate planning needs, income taxes at death, probate taxes at death, that cottage that you have, that there's a huge capital gain. And upon your passing, that there's going to be a lot of taxes owing. Well, the insurance is going to cover that. So these are some of the unconventional things that you would use life insurance for, permanent type of life insurance, and they work very, very well. The other aspect I think we should touch base on permanent insurance. It's become almost like an alternative investment for you too. So here's a key point: you can actually have life insurance and utilize the value in your life insurance while you're still alive. So a lot of permanent policies have dividends within them, and those dividends are growing. They're growing the death benefit, as well as there's a cash value within the policy that you can access while you're actually alive. So if you think about that, because we often think about it at a later stage in life, if you're able to buy life insurance, permanent life insurance at an earlier stage of life, as Brad says, you can get into these eight pays, 10 pay policies where that's all you're paying is for 8 years or 10 years, and then it's completely paid up. If you can do it early enough in life, then that policy will grow. And a lot of our calculations have come out where, there's a very good rate of return in terms of sort of the death benefit based on how much you've put the money, how many premiums you put in. The death benefit, the rate of return is tax free and probate free if set up correctly.
Yeah. And these really end up being a little bit for more unique cases, right? Oftentimes you're looking at clients who have realized in retirement their lifestyle is not all the money that they've saved up, right? They're not going to spend everything that they've got. Or, like you said, Joe, they've got assets that they don't plan on selling, like cottages or other properties, for a long period of time. And when they do, if they pass away, they want to make sure that that's covered, or the cottage can stay in the family, right? That they're able to transition those properties or those assets to the next generation in an efficient manner without taking a big tax hit. So that's definitely one of the most beneficial ways. The other one is also, and we see it now, there's a lot of sort of blended families. And it's a really, really great way to use life insurance to, if you've remarried and you've got kids and your partner's got kids, you can make sure there's money set aside for those kids. It's going directly to them. You can name what's called a irrevocable beneficiary, meaning the beneficiary can't be changed. It always will be that person. And those are ways of really making sure that everything is nice and clean and tidy for your estate when you are bringing into the mix children from different marriages and everything like that. So that's another really, really great case that you can use it for.
Sometimes at the early stages of getting, again, early stages of your life and you're buying permanent insurance, you're really not sure what, the end use of this insurance. I try to explain this to some clients, is that it sometimes is, again, you're acting as an investment, but this investment's going to go to someone or something. You may decide later in life that, to allocate money to a grandchildren, great grandchildren, or to charity or to your church. And those things can change as we kind of go through life. So it's one of those things that, okay, I'm going to get it, I'm going to pay for it, it's going to be completely paid up, and then we're going to determine the use. We can change the end use of it. So it's very, very versatile. I think one of the things that we should also mention is, if you're self-employed as well, or in a partnership, sometimes you'll place life insurance against the other partner. That just helps in facilitating should something happen to the one partner. Or again, if you're in business and you have a main person working for you and you need to insure that person, that's a key man insurance. And those typical policies would probably be more on the term type policies as opposed to the permanent ones.
I think one other unconventional one we should talk about as well is using maybe permanent insurance to put that on to a young child as well. We live in a world now where diseases, there's more and more cases of cancer, different diseases out there, and that's going to be a barrier from obtaining life insurance in your future years. And so, maybe if you've got family history of certain diseases or whatnot, and you've got young kids, you can place life insurance on them even from the age of 1, or when they're born, to guarantee their insurability for life. And you can, like Joe mentioned and I mentioned earlier, pay that up in 8 or 10 years, and they'll have that policy with them for the rest of their life. That'll help them out down the road. And obviously, it's much cheaper on young children to place that life insurance, and really that's setting them up for the future as well.
Yeah, because not only are you giving them life insurance, but it's something they can take with them. And if you bought a right kind of insurance, it could be an influx of cash for them if they really need it.
Yeah, so there's lots of flexibility with that. And when it comes to these unconventional methods, there is a lot. We could talk for plenty of time on these topics, but I think it's important is, if you're curious or interested in these, reach out to your licensed insurance agent or broker. They can have that conversation with you. I know we do a lot with clients on the different techniques and strategies that you can use when we feel may be appropriate for clients and whatnot. One last thing we do want to touch on in this podcast is really determining if you have enough insurance is the first thing, and how to determine if you are covered appropriately for your given case. So, Joe, you want to maybe touch on some of the strategies we employ with clients and going through a bit of a needs analysis with them?
Yeah, it's a really, really simple calculation. Doesn't have to be overly complicated. We typically take sort of the total debts that you have because typically you want to cover the debts off. This is probably more geared towards term type insurance, but again, just looking for an overall needs because then you can have a combination of term and whole life if you need it. So cover off your debts, add up all your debts, add something in there for funeral costs. There's your total debts and funeral costs. Then what you want to look at is your income. And if you're with a spouse, then you're basically looking at each other's income and the needs. If one spouse passed away, what is the need of the survivor? So that's the key thing. So determine that dollar amount, and then we're basically looking at a future value calculation based on maybe 2%, inflation rate. That will calculate a dollar amount. So that's going to add to the debts. So it gives you the total amount that you should have of coverage. And then from that, you want to deduct things that you already have. So you might already have coverage at work, or you might have another policy. You could take a look at other assets and investments that you have to offset. So then once you subtract those out, that will calculate an approximate amount of insurance that you should have. Keep in mind, insurance, when it's priced with the carriers, the various insurance companies, there are bands, pricing bands. So sometimes if you're already at $800,000, going to $1 million is not going to cost you that much more, especially on the term insurance. So keep that in mind. And definitely, understand what you're buying. I think that's a key thing because it is a contract, and once you're in it, you're in it. So you can't change that contract later on. So make sure you understand what you are buying.
Yeah, no, I think that's really important, and I think a lot of people do end up getting surprised when they go through the exercise of looking at what they need, of actually how much coverage that works out to be. But then again, I think they're surprised when you look at term pricing, if you're in your 20s or 30s and you're healthy, of actually how cheap that insurance still is for $1 million or $1.5 million of coverage. So definitely make sure you take a look at it. If you don't have any life insurance now, I think it's something really important to look at. Even guaranteeing yourself future insurability if you are healthy today, I think is important. So that's where we'll wrap it up today. We'll dive into it again, I'm sure, in the future. But thanks as always for tuning into our podcast. Make sure to leave a like and subscribe on whatever platform you are listening on, and we will see everyone next month.